Thank you so much for coming. Welcome to my intimate classroom. This is lovely. My name is Peter. I am the head of insights at Carta. Show of hands, who knows what Carta is? Great, I can skip the first 10 slides then, no problem. I won't do any selling. But my role is, I feel super privileged to be at Carta in my role because I get to make sense of all the amazing data that we have and then hopefully spin it into useful information and narratives for VCs, for founders, for employees, and for LPs who are interested in venture capital. So we're gonna rip through a ton of slides on what happened in 2024 for venture trends, and then do a little predicting about 2025, and then save the last 10 minutes or so for questions. Do I need this? Is it better with the mic? Cool, got it. Noted. I like to start with a little opening from our lawyers just to shake things up. And yes, if you find this interesting, if you find it useful, email me, peter.walker@carta.com, and I will send you this deck. Okay, why should you care at all about what we have to say about venture capital? Well, currently we aggregate and anonymize data from more than 50,000 startups that use Carta as their cap table management platform. That's about 55% of all startups in the US that are seeking venture capital. Of the Crunchbase has it at about 770 US unicorns alive today. We have about 83% of them on the platform. So when it comes to VC, we're the market leader. Agenda, we're gonna go through VC since 2018. We're gonna talk about today's fundraising, a little bit of AI, employees and exits, kind of try to cover it from all angles. So let's get this out of the way. VC has gone through a bit of a tumultuous time over the last, call it 6 or 7 years. One of these years was an outlier. One of these years was the weird one, and it's not 2024. Okay, 2021 was an aberration. We basically all lost our minds, whether it was low interest rates, free money, et cetera, crypto, the pandemic. I get it, there were lots of excuses, but we also overfunded to a wild degree in a way that we've never done before. So when you're thinking about what's happening in venture capital today, you have to remember we're dealing with a hangover of a lot of bad choices that were made in 2021 and early 2022. Those have consequences. What are those consequences? So if you look at this from the peak, so Q1 2022, what is the total capital invested quarter over quarter by stage versus that earlier peak? And you can see it's no fun for anybody. It's worse the closer you are to an IPO, but no stage has really escaped this downturn. It's not like seed is doing great and everyone else sucks. How many of you are founders in the room? How many of you are VCs? Okay, great. No earmuffs for anybody then. I don't have to be too worried. If you are a founder and you're working off this old venture capital assumption, which is I am going to fundraise every 18 to 24 months, which used to be the timeline in VC. And you can see that in many cases since 2019, that's very true. A lot of companies were fundraising every 18 to 24 months. That is out of date. If you have 18 months of cash left on your books and you're a founder, think about what you're gonna do next for cash, right? Because sometimes it's taking you 24, 30, 36 months in between fundraises. You have to make those dollars last a lot longer than you used to, in most cases. And if you aggregate that up to the whole ecosystem, what does that mean? It means that private companies are staying private a hell of a lot longer than they used to. So if the median time to IPO used to be 8 years, now it's more like a dozen, or even 13. And that can seem like, okay, a pedantic change, right? You're just extending the lifetime in private markets, but it's actually a gigantic shift that underlies everything in venture capital. If you are a VC fund manager and your expected lifetime of that fund is 10 years, way too short. More like 13 or 15 years before you're going to get full DPI back to your investors. That changes everything. Time matters here. Speed matters. So what have the wonderful VCs in this room been doing over the last couple of years, if not investing as often into new companies? It turns out they've spent a lot of time supporting the companies they've already invested into. So the percentage of bridge rounds, defined as rounds at a flat or slightly lower valuation to companies that the VCs have already invested into, they have spiked in recent years. And I'm sure if you're a founder, you kind of know this game. Hey, we thought we were going to get to Series B but we need a little bit more cash because we just don't have the metrics for it yet, et cetera, et cetera. We need these to probably come back down to more historical averages in order to talk about a fully healthy ecosystem. And if you can't raise a bridge, what do? You might raise a down round. Those are not fun, right? 20% of all the rounds on Carta in 2024 were down rounds. That is 2x the historical average. That is nobody's idea of a good time. That sucks for founders, it sucks for employees, it sucks for everybody, but it is way better than shutting down, right? So I actually view this as somewhat of a silver lining. I wish that the stigma around down rounds, I realize why it exists because we're operating in a market with very little information, but Facebook took a down round. You can survive and still be a fantastic company after a down. It does happen. Of course, the deals themselves, the valuation matters, obviously, but the terms of the deal also matter. So things like high liquidation preferences, participating preferred stock, cumulative dividends, these are all terms that favor the investor over the founder and employees, and they've become more common lately. Good to see that they're really not very common still in seed and Series A. Most of the deals on Carta are still clean deals, 1x liquidation preference. But you can get 2, 3, even 4x liquidation preferences in the late stage. Does everyone know what liq pref means, liquidation preference? Just one, and he was waving, so I don't actually know whether or not that was okay. Good. you won, sir, but we won't count it. So liquidation preference in this case just means 1x liquidation preference means that the VC will receive all of their capital back in the event of an exit before anyone else receives any capital. So if you have a 2x liquidation preference, that means the VC receives 2x their initial investment before any of the rest of the cap table sees any of that wealth. So imagine you're a company and you get bought for $200 million, but 150 of that goes back to the VCs before it's shared amongst founders and employees. You can have a big sticker price on an exit and not a lot of actual wealth generated for many of the participants on the cap table. So liquidation preferences matter a lot. And if you're thinking about this from the VC perspective, we saw from the founder angle, hey, it's taking longer to fundraise. Great, good to know. From the VC angle, if you look at it at a portfolio level, you might say, how quickly are my portfolio companies going to get to the next round? And why does that matter? Because if I'm a VC and my company gets to the next round, I mark that valuation up and I have better performance to show to my LPs. So, interesting chart here. This is when you raised your seed round. And this is how long did it take you before you raised your Series A. So 8 quarters in is 2 years after your seed round. What percentage of companies had raised their Series A or not? If you raised your seed round in 2020, nearly 40% of those companies hit Series A in 2 years or less. If you raised your seed round in 2022, 15% had gotten from seed to A in 2 years or less. Again, a gigantic shift. It means there is a glut of companies at every stage along the way. So VCs are having to make more difficult decisions. And all of this resolves, sadly, in startup shutdowns. So who reads TechCrunch? Smart room. The ones that don't. No, love TechCrunch. To be honest, this is a scary chart, right? Hundreds of VC-backed companies shutting down every quarter. It sucks. No doubt. It definitely sucks. But it is to be expected. We funded a whole hell of a lot more companies in 2021. Unless venture capitalists got much better at hitting on the right companies, you would expect most of them to still fail. And so fail they have in years on. So just as a heads up for the TechCrunch readers in the room, you will read about some majorly funded startups this year that are shutting down, inevitably. It doesn't mean that the ecosystem as a whole isn't functioning as it usually does. 9 out of 10 VC-backed startups fail. Depressing, but with an exclamation point, because I have optimism at the end of this, I promise. So, how about fundraising today? What does it look like right now? So if you're raising pre-seed, how many of you are founders with pre-seed companies? You haven't fundraised from VCs yet. Okay, cool. This will be useful for you all. We took a look at how companies are bringing in their earliest dollars. And probably no surprise to many of you, the SAFE, the Simple Agreement for Future Equity, has just sort of boat raced the rest of the funding instruments in this part of the market. So it used to be you'd either raise on a SAFE or a convertible note, and now 90% of companies are raising on a SAFE. That's not quite as true for biotech and some hardware companies. If you're building physical things in the real world, hey, having a convertible note with an interest rate maybe makes a little bit more sense. But for the vast majority of software companies, the SAFE has just sort of overtaken every other funding round. We can talk about why if you want, and whether or not it's smart. In terms of type of SAFEs, I challenge you on this chart. When did Y Combinator take the pre-money SAFE off of their website and just leave the post-money SAFE? Yes. Hey, you work at Carta, Neil. Don't do that. You're a plant in the audience. I was going to use you later. Damn. Yeah, like 2019. So this is a wonderful chart because it shows you what the market is, but it's actually a chart about the power of defaults. There are certain actors, especially in Silicon Valley, who just have sway. And what they demand as their default way to fundraise becomes the default way that many companies in Silicon Valley and then outside of Silicon Valley fundraise later on. So 90% of these SAFEs are post-money SAFEs. That favors the investor, not the founder. It's still probably good because it's more clear for everybody, but it favors the investor. So the number one question I get, Peter, I'm a pre-seed company. I'm going out to raise $1 million. What should my valuation be? And I say that should be valuation cap, not valuation, because you're working on a SAFE. It's not an actual valuation yet. But if you run this math, if you're raising $1 million on a SAFE, the median valuation cap right now is $10 million. I agree. Crazy, wild. So again, 1 million raised for a 10 million cap, which means you have sold 10% of your business. SAFEs are not free, right? It can feel free because you get cash up front and you promise equity in the future. They are not free. They're actually rather expensive when you look at it. This orange line is AI companies. The black line is everybody else. Unsurprisingly, AI companies are raising for slightly higher valuation caps than other companies. VC has to have a hype cycle at all times. This is our favorite one right now. Okay, seed round. The black line here is the median pre-money valuation of seed stage companies on Carta when they were raising quarter over quarter. The bars are the number of rounds. So this tells an interesting story. First off, nearly $15 million pre-money valuation for a seed stage company on Carta. You add in, they maybe raised $3.5, $4 million. You're talking about a nearly $20 million valued company at the seed stage. Expensive, incredibly expensive historically. But if you look at the bars, nearly 900 companies raised the seed round. In this quarter, less than 500 did here. So yes, valuations are high, but fewer companies are being able to raise at all. So if you go from 21, basically the bottom quartile has just been lopped off. Those are just deals that VCs are not doing anymore. Whether or not that's good, we can debate it. So that's an expensive valuation. If you go to Series A, again, quite pricey historically. I haven't adjusted these numbers for inflation, so probably not quite as pricey as they look. But 45 million pre-money valuation on a $10 million raise, you're talking about a $55 million valued company at Series A. Expensive. Very expensive. Same thing for B. If you go to B and C and D, what you start to see is that, hey, look, in seed, we barely went down at all, and now we're back. A went down a little bit and back. B, much more of a decline. That would have been bad. C would be even steeper, D even steeper, right? So the ones that were closer to IPO took a much bigger haircut than the early stage. How much of your business are you selling in these rounds? This is one place where the standard venture advice actually holds very true in our data. 20% in your seed round, 20% in your A round. Why is it so consistent? There's all these deals for different sectors, et cetera, but it always kind of resolves back to 20%. Why is that? Not a trick question. Yep. Boom. This has barely anything to do with the companies. This is all about the investors, which is I, as a lead investor, want to own 10 to 12%, maybe 10 to 15% of that company in the round, and I invest at this sort of check size, ipso facto, boom. from the fund economics comes the dilution most of the time, unless you are a really hot company and you can dictate terms to VCs. As you get bigger, you sell less of your company, right? These are much more mature, they've solved a lot of risks, therefore VCs have to pay more for equity. Makes sense. When we look about how, at least on Carta companies, again, this is about 50,000 startups in the US, where is this capital flowing to? The locations on this chart are dictated by the headquarters of the company. So it has nothing to do with where the investors are. Bay Area took in 39% of all capital this year. But San Diego's doing really well, I would say. 2.9% of all capital, but you can see 2.9, 3.1, like effectively in a very tight race between 5, 6, and 7 with Austin and Seattle. No one's surprised here, very strong in biotech, but growing in other areas as well. And I think that the comparison between San Diego here and Boston at 8.6 is a very useful one. If we had looked at this chart 5 years ago, Boston would have been exactly like San Diego, really spiky in biotech and not as much else going on. But over the last 5 years, Boston has become a SaaS hub, a health tech hub, a hardware hub. Heck, they even have a little bit of consumer in Boston. So one spiky area can lead to innovation in other places. And I'd say that San Diego is actually well on its way to following that same path. So from biotech, period, to biotech, comma, and a lot of other stuff. Pretty cool. Okay, AI inflection. First off, I know I was depressing you at the very beginning. 2024, we did see more funding raised than 2023. Great. Not a ton. Maybe that number gets to 85, 86 billion when it's all said and done. Call it 15% higher than 23. It was a good year, not a great year, but hey, we're not falling anymore. That's awesome. But where was that money going? It was going to AI in many cases. So the sort of salmon is funding to AI, the black is funding to all other companies. And interestingly, usually when we have these paradigm shifts in technology and venture capital, you see them at the earliest stages first. And then they kind of make their way into late stage as those companies get bigger. The weird thing about AI is that it's kind of everywhere all at once. Now we can debate whether or not those Series D companies are actually AI companies or if they're just making a lot of OpenAI API calls, sure. But from the data that we have from investors, they seem to be treating them like AI native companies. So along the route here, 25% of seed going to AI climbs and climbs and climbs until about 50 cents of every dollar invested into AI companies at the late stage. Now, obviously, that is dictated in some part by the gigantic rounds that you've seen raised on in the headlines, those of you that read TechCrunch. Actually, those make it out of TechCrunch. Those go to the Journal and New York Times as well. Billions and billions of dollars going into AI native companies. So how does that look by valuation? Solid lines here are pre-money valuation. Dotted lines are the total cash raised in a round. Median cash, I should say. So if you're an AI seed stage company, you have a 42% valuation premium over a non-AI company right now in 2024. Does that mean that all those companies will end up 42% more highly valued and exit for 42% higher than their peers? Definitely not. But hey, we got to have a hype bubble somewhere. Or else where's the fun? Same thing at Series A, 30% valuation premium, 20% cash. And then if you look at Series B, these numbers bounce around depending on the quarter, but again, 50% premium valuation, 30% higher cash. So if there is a bubble in venture capital right now, it is within AI companies. VCs are willing to pay up for them. And that means that those AI founders have a little bit of negotiating leverage in many cases when it comes to dilution. So these aren't giant gaps, 1%, 1%, et cetera. But they add up over time to the idea that the founding team in an AI company might own materially more of the company when they get to Series B than a non-AI, if they follow those medians. And you can see that for the non-AI companies, the 75th percentile, so this is the deals that are really favorable to investors, they're much higher in many cases. Usually that's because that company has one term sheet and they're negotiating with one investor. And that investor kind of drives a hard deal. but the company needs it to stay alive. SaaS. So this chart shows the black bars are the percentage of deals going to AI companies. The orange is the percentage of cash going to AI companies. Obviously, AI is big in SaaS, Gen AI, whatever. Hardware, we've also heard about it infiltrating robotics and other places, but it's basically across the board. Even in Web3. There's that joke about all the crypto VCs becoming AI VCs. Well, now they get to be both. You can hyphenate it. It's very exciting. There is a bit of a difference between digital and physical AI. So this is biotech and hardware mostly. This is marketing, sales, all the AI stuff that we normally read about. VCs, this is seed stage valuations on the bottom and seed stage cash raised on the y-axis. This typically, you can see all the bubbles sort of float along the same line because that's based on the dilution. If your valuation is higher, you raise more cash, so it's about 20% every time. But there is sort of a premium being assigned to a smaller number of physical AI companies. So one of the things that we're watching for this coming year is AI becoming really ensconced in places like biotech, pharmaceuticals, medical devices, et cetera. We're seeing a lot more of that than we did in 23 and even in 24. And none of you have asked so far, but I'll answer the question in your heads. What is an AI company? Right. How did we decide, right? Did we as Carta spin up a venture capital deal team and go and investigate all 50,000 of these companies? No, we did not. We asked the founders, are you an AI company? Are some of them lying to us? Yes, they are. But in good faith, I'm sure they believe deep down in their hearts that those Claude API calls constitute an AI company. However, based on these valuations, investors agree, right? If those lines had been exactly the same, I would have said, okay, a lot of founders are lying to us. But venture capitalists are also having a difficult time figuring out what is true, quote unquote, AI, what is meaningful differentiation, what is defensible differentiation. All of those things are very up in the air. So we laugh a little bit at the idea of a GPT wrapper getting a super high valuation. What is Salesforce but a wrapper on Excel when you get right down to it? Yeah.
In that bubble chart, where would an AI SaaS company be? Would they be in the gray SaaS bubble?
They'd probably be like in between these two right here. Yeah, depending. So these, by the way, these AI bubbles are aggregates of, you can be a SaaS AI company, you can be a fintech AI company, and those are both counted digital. So it kind of pushes it over. This gets to a question that you all do not need to sympathize with me for, but taxonomy is a complete bitch in this field. Like, it is so hard for me to go through these and figure out what stage they are. We're using a ton of different sources. If you have a great one, let me know. I like harmonic.ai. I don't know if you all are familiar with them. They do a really good job of categorizing companies, but they use AI to categorize AI, and sometimes it's wrong. And then I have to yell at an AI, and it feels very dystopian. And if AI is this coming wave, then it lives in the Bay. So about half of the AI dollars that we see invested today are into Bay Area companies. And actually, weirdly, South Bay, Palo Alto, Menlo Park, et cetera, is basically, it used to be sort of the capital of VC. Now it's San Francisco City proper. There's actually a lot more where this is happening. Okay, last section, and hopefully you're prepping your questions. I'm going to save you a bunch of time for Q&A if you'd like. So there's a ton of turmoil that's happened to VC-backed startups over the last 5 years. What does that mean for their employees, the people who work there? I think this is a really shocking chart to me, although not too surprising when you think about it. So these black bars represent net headcount growth across all Carta startups. So this is not just new hires, but new hires minus the people who left, either by choice or through layoff, whatever. So Carta companies grew by 53,000 employees in a single month in 2022. But since 2023, they basically haven't grown. So what does that mean? Founders like yourselves stopped hiring. Every single new hire is being scrutinized much more closely than it was in 21 and 22. And I see some nods in the room, and you're probably thinking to yourself, good, right? We overhired. We got out of our head of our skis. And that was true, sure. We saw a ton of layoffs. That really sucks. We've seen fewer layoffs in 2024. That's good. But it does present this question, which is like, what wither the future of startup employment. This is the percentage of people that leave year over year, startup employees. So most startup employees do not see the end of their 4-year grant. Most leave within 3 years. And you can see the lines show you year cohort by cohort. That's the year that they were hired. Recent years are leaving more quickly. Some of that is obviously layoffs, but some of that is also leaves by choice. And on an aggregate basis per startup, if you raised your Series A round in the first half of 2020, you probably had about 20 full-time equity holding employees. Now you'd have 16. And if I did this for the second half of 2024, which I will in a couple months, I bet that's going to be more like 13. Small teams moving quickly. ARR per employee. Yes?
Do you have any data on percentage of these employees that are participating in private markets?
We can talk about that. So the question was data on the percent that are able to participate in the private markets. So this is actually pretty easy. If you are a seed or Series A or even Series B employee, the answer is almost zero, right? Almost none. If you are a Series D, C, D, and beyond, we can talk about how that looks. If you work at Databricks, congrats. If you work at OpenAI, congrats. But it's a much smaller percentage than people kind of cotton on to. So again, if you're looking for a job in startups, how many of you are students here? Okay, I'm sorry for what I'm about to say. But if you're looking for a job in startups, here's how your comp has changed over the last 2 years. The orange line is salary. Basically, if you joined a startup in November 2022 or April 2024, you're getting paid about the same starting salary. Now, that's less because inflation, right? But at least it hasn't gone down in absolute terms. Your equity package is about 36% lower. That's a massive shift. Why has that happened? Couple reasons. One, you as a candidate are looking around on all these startups and you're like, I'd actually rather have more cash, right? Cool, keep the cash high. If you had to knock the equity down, but like, I care about cash more. So it's a little bit on the candidate side. Two, if you're walking into a negotiation about your startup offer, very likely you have a range in mind for your salary, and for the equity, you're like, yes, some would be good. But some is not a good range, right? You should have a before and after. And thirdly, founders' boards are coming down hard on them on option pool burn. Very hard. So all of these changes, it's easier to change equity than it is to change salary. This is always more variable. But we're seeing this not just with entry-level employees, but with mid-level managers and even VPs. C-suite hasn't happened. They get paid a lot. One note, if you are thinking about joining a startup in the near future and you are in negotiations with that startup, I highly suggest that you write down this website, carta.com/friend. Tell us a little bit about your role. Hey, I'm applying to be a level 5 engineer at a company that's worth this much in San Diego, and I will give you exactly what I give HR talent partners, 25th, 50th, and 75th for cash and for equity. So you can walk in with knowing whether or not you're getting screwed. Totally free. Share that with friends only. So of course, we just went over the shifts in comp, but it matters where you live. There was a moment in 2021 where everyone got really excited about the idea that we're going to pay everyone the same, no matter where they live. That is not true. Not only do big companies not do that, basically no startups do that either, unless they're fully remote, which is a totally different thing. So how much will you make in total salary versus if you lived in San Francisco? So San Francisco is 100% top market for us, and then on down the line, San Diego is about 90% of SF rates. Now, does it cost 10% less to live in San Diego based on rent? Maybe. So you might be coming out ahead there. This is not purchasing power, this is just raw salary. And you can see some markets moved closer to SF last year, some markets lost a little bit. There's always kind of a labor game going on. Okay, so we're shifting from employees now to exits, which is what the VCs in this room probably care about, but the founders should too. This is a crappy chart. This is the number of technology IPOs as defined by Coatue over year since 1996. The worst 3 years since 96 have been the last 3 years, right? Those are terrible numbers. Will we see more IPOs in 2025? Show of hands for yes. Show of hands for no. Okay, this is an optimistic room. I like that. You're probably right. You're probably right. We can talk about mergers, we can talk about secondaries, we can talk about all the other ways you get liquidity. This is what matters. We cannot have a healthy startup market without IPOs. It's not possible. So, if you know a late stage founder who's thinking about it, give them a call. Tell them, look, we talked about it at TechCon and we would like you to go public. You have our support. No, but honestly, I think that this will be the metric to watch. It's a lagging indicator. Companies go public once they feel like it's a good time to go public, not before. So it does lag the other metrics, but it is the most important one. Sadly, if I'm going to make a prediction here, is that we will have more IPOs this year, but not the biggest companies. The ones you all know about probably won't go public. I'm talking specifically here of SpaceX, Stripe, a couple other ones. Why wouldn't they? They have unlimited access to capital in the private market. SpaceX can go out tomorrow and raise $100 billion. That's not a joke, if they wanted to. So what's the point of going public? Increased scrutiny from the SEC? That sounds fun. The SEC already loves Elon. Why not add to it? Sounds amazing. No. A level of capital available to the biggest late-stage privates in the US has never even been close to what it is today. And that has a material change to their thinking about going public. I think in 5 to 10 years, this is going to be a public policy problem. Good for those founders, right? Probably good for those employees because you can get secondary liquidity as well. But it's an issue for American economy as a whole. That's a prediction. However, there are M&A transactions happening. I know people got really excited about, or some people got very excited about this new administration's perhaps more lax policy towards M&A. Really, the whole thing about lean econ and M&A only really ever applied to a very tiny sliver of companies. The vast majority of startups that are bought and sold are Series A or before. So what I don't have in this chart is who made money off of these transactions. Were they all just acqui-hires and fire sales and founders didn't make any money, or were there some really good accretive transactions in them? My instinct is that a lot of them were kind of not so great over the last year, but slightly getting better when we talk to VCs. And 170 companies is nothing to sneeze at. So you will see more M&A picking up as well this year. Who buys these companies? 3 people, other startups, big tech, private equity. And private equity has been the most interested of late. Maybe big tech gets really back into the game after January 20th. For no reason. Secondaries. So this is total events, total liquidity transactions, and then total capital transferred in those liquidity transactions in tender offers by US companies. So this is not you go out on a shady private market and find a buyer. This is the company is running a tender offer. Most employees can participate. Do you want to sell some of your stock before IPO? Peaking back up a little bit, not tons, but these typically follow primary rounds. So as we get more funding, I would expect this number to pop back up as well. I know we have about 10 minutes left. So in summary, all of these metrics suffer from the hangover of 2021. That is the proximate cause of much of this turmoil. And the weird thing is we had a downturn and then a bubble at the same time with AI, because ChatGPT really came onto the scene in late 2022. So that's kind of thrown everything a bit even more confusing than it would have been. AI hype bubble is very hype. There will be a ton of money wasted, but there are also going to be some major fortunes made. If we want to see venture back to quote unquote full health, we need exits, and those exits need to be IPOs. And it is my contention, as usual, that it is, as always, a great time to start up. And maybe not take VC capital, maybe bootstrap it this time. Okay, next up from us, for the founders in the room, and the VCs if you want, We looked at 45,000 companies, and we looked at how much does the founding team own. Not just at the start, but at seed, after your A, after your B, including option pool versus investors, by industry, by location. It's a huge report. I'm super excited about it. It comes out next week. And yes, there is some data on CEO ownership as well within there. I said CEO, and one or two people who weren't got back up. Okay. I won't pitch you, but Carta's awesome. If you haven't raised from VCs yet, this is our launch program, free cap table. So you raise $1 million. All of our features for free. If you are raising a priced round, this is new, they're very expensive. You can spend 50, 60, 70K on lawyer fees and other things when you raise a priced round. If you do it through Carta, we are not going to replace your lawyer. You still need a great lawyer. What we can do is take the admin tasks of when you paid a paralegal to send signature packets back and forth. We can do that for free for you. Hopefully save you some cash on your price round. Let lawyers do what they're good at, which is negotiation. Giggles? So rude. Sorry, lawyers in the room. All right. I'll pause for a moment. Questions? Yes, sir.
One about the slide that San Diego paid 10% less than San Francisco per employee's salary.
Yes.
Can you tell us what the number was in San Francisco?
Well, it's different depending on, are they engineer, are they a marketer, et cetera, et cetera. So this is an average across hundreds of thousands of employees. So I'm not able to give you a specific number. But if you want, you can go to carta.com/data, and there we have all of our reports, and there's one called State of Startup Comp, and we do have some more specific numbers on that one. Yeah?
In that very colorful slide, about 20 slides ago,
Mm.
it said 36 to 39% of the companies did the Series A within 2 years.
Yep.
15%.
Yep.
If you look to the right, the 36 grew to like 41 and a quarter. Not very much.
Totally.
We're at 15 today.
Yep.
Is it going to go to 41 in a year, or is it not going to grow?
That's a wonderful question. So I think that if you look at graduation rates, it's actually really interesting by stage. So this is just seed stage, but we can talk about it across the board. Wow, that was a long time ago. There we go. So you can see it resolves right around 45 to 46, et cetera, percent, right? So one, does that seem high to people? Half of seed stage companies get to the A eventually. Sounds high, right? Yeah, I thought it was high too. Maybe there's some bias introduced there, but so these are 40 and then it stopped growing, right? Because then it was into the 2022, 2023 period where there was far less funding. So 2023 happened to these cohorts at different times, which is why you have to look at them over time. Will this 15 get to 45? No, almost certainly not. My bet is no, based on insider information. Based on our data. I don't think we're going to get to 40. I think we'll be at 35, maybe. I think it will be a materially lower cohort. Forever. Yes. Many of those companies won't. Two reasons why. If you raised a seed round in 2022, you raised money at the very peak. Since then, there has been very little funding available to you, and AI happened. So if you were a standard sales tech, MarTech startup, and you raised a seed round in Q1 of 2022, what have you had to do since then? Probably some layoffs. Reimagine your entire tech stack. Maybe your eventual product market fit. What people get wrong about the period here is they look at it and they go, ugh, how could VCs be so stupid? All these companies were never going to amount to anything. And then you look at those companies' growth rates at that time, and you were like, wow, these companies were growing really quickly. And then interest rates tripled. And they found out that their product market fit didn't exist in a high interest rate world. It existed in a low interest rate world. Should they have known that? Maybe. But it wasn't like these companies, the standard thing is like, oh, these companies raised on a PowerPoint and nothing else. No. A lot of them raised on crazy high growth rates that stopped. And then you have to change. So I don't think we're ever going to get back to 45% there. Yes, sir.
Do you have any other view on getting liquidity since the length of time has gone, whatever, 12, 15 years?
Yeah.
Secondary marketplaces will provide liquidity as some of the trading platforms exist that have no activity today, very little. Do you have any view on that, where that's going? and specifically about digital assets, do you see any action with digital assets with Carta and other platforms?
Yeah. It's like a whole other 2-day talk, really, about liquidity and secondary marketplaces. I mean, yeah, I'm sure some of you have read this. Like, we at Carta have very deep experience with secondaries, and we shut our Carta X business down a year ago. And you can read about why. Henry, our CEO, has written some really interesting things about that market. Fundamentally, the problem with secondary markets, and it's not to say there aren't pretty good businesses like Hive and Forge to be built there where you can have direct sales, is the founder does not want those shares traded. That is the principal agent problem in the secondary markets. Until you are OpenAI and you're like, whatever, doesn't matter. If you're a Series A company, you do not want any of your stock changing hands. 1, you want to control who's on your cap table, obviously. 2, you don't want it priced. The point of being private is to price your own stock, right? In many cases. So I just think that many employees will try to get liquidity, and many founders will say, we'll have the right of first refusal on that and say no.
But today, just a quick thing.
Sure.
Today, of course, the issue of retention of employees. Today, there's a huge discount.
Yep.
But if you had a traditional marketplace, buyer and sellers trading,
Yep.
you wouldn't have those kind of discounts. So I'm just wondering, do you see a vision of that, or you don't see that happening? Because we looked at liquidity 5 years ago. People say, 5 to 7 years. Sure. Now we're my grandchildren.
Correct. Yes. Yeah. So I mean, yeah, we tried to build that marketplace, right? We spent 4 years and $80 million trying to build that marketplace, and we didn't work. It didn't work. Now, maybe we were the wrong people to build it, right? Totally fair. But I think it's a really difficult challenge that requires not just product market fit and intelligent tech, but a lot of regulatory changes. So it's really hard. Yeah.
I just looked at the website.
Yeah.
And I was looking at the mission is to create more owners.
Correct.
And how is this connected to that mission? How are you gonna?
I think that the create more owners mission, so Carta's gone through a couple different transitions, but the full idea of Carta at the beginning was to incentivize ownership in private companies. The idea is to move employees from the salary stack, which is debt, to the equity stack where you can generate real wealth. Now, there's obvious problems with that. We were talking about liquidity markets. How much of private equity compensation ever results in dollars for the employees? Not a lot. Very little. But I'd still rather have that upside than not have that upside. I think I have time for one more question. Yeah.
You mentioned it's a good time to do a startup, especially if they're bootstrapping.
Yeah.
Do you have any information on early angel funders? What about their outlook?
Yeah, I think it's a really interesting time to start up and take money from a few angels. The question is what instrument is best to do that on? The safe feels good, but if you never raise the price round, then it doesn't have to convert, and that leaves you, the angel, sort of out of the loop. Maybe a safe with a modifier that says, hey, this converts at X percentage, blah, 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 down the road. I think this is an amazing time for small teams to not take VC and build really cool and interesting businesses. And then if they need to pour gasoline on the fire, then you start talking about it. So many more companies that we're talking to are saying, we're not even speaking to VCs, we're building a business first, and then we'll talk to them down the road. One last question. Yes, sir.
Yeah, in that vein, do you have any information on debt, what companies using debt in the interim?
We don't have a lot of information. From our discussions with VCs, there was a huge cliff that happened in debt when SVB broke apart, and the market hasn't really reformed since then. But also, I think venture debt for early stage companies makes almost no sense. I think venture debt should be reserved for companies with real revenues and later stage. Venture debt is a fun way to be beholden to someone for a long time for a company that almost certainly won't work at the early stages. So, in any case, I really appreciate your time, everyone. Thank you so much.